Now, you know the S&P is down, what, 15% this quarter? There's been a lot of volatility. The SEC's, one of your main jobs is to maintain fair, orderly, and efficient markets. Is there anything that you have seen in the market volatility recently that concerns you or would cause you to believe that the SEC needs to step in some way?
Every day we are looking very closely at what's happening in the marketplace, and we're trying to make sure the systems are working, that price formation is happening, and that everything is happening in an orderly way. And so if there's a lot of selling and prices are going down in certain circumstances, if that's happening in an efficient and orderly way, then sometimes that's just what happens. So,
and it's your opinion that as much of the volatility there's been, it's been orderly and efficient. Is that the SEC's viewpoint?
I think that the things that we look at are things like, are there mini flash crashes? Are there market dislocations that are caused from fat finger errors? Are there things that are potentially going to trigger a limit up, limit down halt? Are there things that illustrate that perhaps some systems are not functioning the way that they're supposed to function? But if the systems are functioning right, if we're not seeing market halts, and if things are simply being created by the interest that's in the marketplace and things are happening efficiently, then sometimes that's how it works.
And are the systems working right?
We have not had any significant notices. So there's a rule that we have called Reg SCI. It stands for Systems, Compliance, and Integrity. If there's a problem in one of the marketplaces, they actually have to report. We're having an SCI event. So they will come to us, they'll say, we had an issue, something broke, a system didn't work, something like that happens. That would be a red flag. We haven't been seeing those.
Okay.
We have limit up, limit downs also, those sorts of halts. We haven't seen an extraordinary amount of halts. So when that's not happening, we think that prices are moving, but they're not moving in a way that looks like it's really dislocating the marketplace.
Fair enough. Now, Leon Cooperman's a frequent guest on this show. We've known him for many years. He was on a couple of weeks ago. He had several concerns about the market volatility and perhaps your role, the SEC's potential role in it. Let's take a look at these two comments he had, and I'll get your reaction on the other side.
Well, I think your next guest ought to be somebody from the SEC to explain why they have sat back calmly, quietly, without saying anything, and allowing these algorithmic trend-following models to wreak havoc with what has up to now been the best capital market in the world. In the mid-1930s, they instituted the Uptick rule to deal with the abuses of 29. It worked effectively for 70-odd years. They took it out in 2008 for some unexplainable reason.
Well, let's take the first comment. He expressed concerns about these quant funds that are out there. Many of them are trend following, and of course they come in the middle of the day and move their portfolios around. It's caused a lot of volatility. Is there anything the SEC sees about these quant funds, trend following models that concerns you in any way?
You know, we have to think long and hard before we start going out and judging specific investment strategies that people have in the marketplace, right? Which is why we're much more focused on whether or not things are working systematically correctly. I can tell you this, that we do talk to Treasury, we do talk to the Fed, we do talk to the other regulators, and so we're coordinating as much as we can. And I will just say that if we see something that is highly problematic, then we'll take a deeper look at it.
What about bringing back the Uptick rule? This is the rule that used to prohibit short selling on a downtick. It was eliminated in 2008. Do we need to bring it back?
Right, so the Uptick rule, interestingly, was eliminated after a 2-year pilot where they studied certain stocks that they took out of the Uptick rule. After a great degree of deliberation and research and study, it was determined that it wasn't needed. Because remember, around that time, markets were going electronic, right? That was right after Reagan MS and automated markets. So the Uptick rule in markets that are continuous like that didn't work so well. I will say this, there is a rule that deals with that kind of short selling activity that is deemed to potentially be excessively problematic, which is short sale rule 201, and that was instituted in 2010.
So there is a short sale rule that does exist out there.
Right. There's a rule so the idea of this rule is that if the market has already dropped by a certain amount, then short sellers should not be able to hit bids, right? They shouldn't be able to cross the spread. So if the stock has dropped more than 10% from the prior night's close, then a short seller would have to sort of sell only on the offer. They wouldn't be able to cross the spread and hit the bid on the market.
We got to go, but you announced a transaction fee pilot yesterday that's going to look at the rebate system. What is it you're trying to accomplish here, very briefly? We got to get
Bob, it's all about data, right? We have a number of market participants who are complaining about the maker-taker system. A lot of people have raised a series of issues about the rebate structure. Does it create conflicts? Does it create excessive intermediation? A whole set of issues. All we want to do is study this, get data so we can make an informed policy decision based on empirical data.